Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday ETF report. And we're going to take a look at the major ETF sectors over the past year to date and also over the past 5 years. We want to show you something very, very important relative to what's going on with using the clean surplus methodology, which means you're picking the top stocks out of each ETF rather than the entire ETF itself. Because don't forget, every ETF, every index is made up of the stocks that are outperforming, in other words, the above average stocks. It also contains the below average stocks. And what clean surplus does, it picks the top or the better performing or the better than average stocks in each area. May 10th, 2025. Remember, folks, if you want to live on the beach like Jimmy Buffett once did, you've got to invest better than Warren Buffett does now. And let's look at the year to date, and these are the ETFs that are outperforming the S&P 500. S&P 500 in all these slides is the black line. So if we're looking at the XLI, these are the industrials up here, the orange line, XLP, consumer index, XLU, the utilities are outperforming, and the financials are outperforming. And we just want to focus on the financials for right now. So all of these four that we just mentioned, four ETFs that we just mentioned, are outperforming the S&P 500 year to date. So that's just this year. We're talking about 4.5 months. Now, over 5 years, we can see that the utilities down here, the blue line, are way underperforming the S&P 500. Again, S&P 500 is the black line. Utilities are totally underperforming, and the XLP, which are the consumer staples, totally underperforming. Now, what's outperforming? The financials, which is this brown line up here, and the industrials, which make up a lot of the Dow stocks, but other stocks also have been doing very, very well above the S&P 500. So when we look at some of these stocks that we want to select for our portfolios, and I'm going to go over those in a second, we want to pick the better than average stocks in any ETF or any index. So let's look at the financials. This comes right off the computer program, and we took the financials and the top stocks in the financials. Now, all of these stocks, just about all of them, are outperforming the S&P 500, and some of them look very familiar to you. Why? Because we've had them in our growth portfolio, and some we still have in our growth portfolio. Erie Indemnity is in our portfolio right now. Apollo had been in, it's no longer in there, replaced by Erie. Blackstone we never had because Arthur Gallagher, which is almost in the same industry, is way outperforming Blackstone, and we've done a Saturday report on comparing these two stocks. MSCI, which is MSCI Company Incorporated, had been in our portfolio. CBOE had been in our portfolio. MasterCard and Visa down here, both recently taken out of our portfolio because they're getting so big they just don't outperform much anymore. BlackRock, I mentioned, BlackRock has been replaced by Arthur Gallagher. Ameriprise we had at one time. S&P Global we had at one time. FactSet Research we had. Market Access Holdings we had. They're into the bond trading. So we've had most of these companies in our growth portfolio at one time or another, or in one of our ETF portfolios. And this is just right from the computer program, from the highest ROE to the lowest ROE. Now, we look at other aspects other than ROE, like the future revenue growth. We look at the better than average, or maybe in some cases below average revenue growth and net income growth. And of course, we look at debt. So we look at those areas and then we say which ones are performing better. And in the financial, just about all of them have. And had you just picked these stocks, you would have outperformed the financial index or the financial ETF. Why? Because it goes from the highest to the lowest. I'm sorry, I don't have those numbers in here, but they are all above 20% to be sure. And how did I do my research way back in the beginning? I just went to my spreadsheets. It wasn't in computer form. They were just spreadsheets. And I picked the highest to the lowest, and that was it. Didn't look at anything else. And it worked. It worked very, very well. And that was the start of our research and showing the world. It was a doctoral research. So when you do a doctoral research in an area, you are one of the most knowledgeable people in that area in the entire world. And so this is how we started, by looking at, well, this is a computer program, but we looked at the spreadsheets. The spreadsheets come, or the computer program comes from the spreadsheets. So let's look at year to date in some other stocks down here. And we are looking at the oil and gas down here, the yellow one, XOP. I thought it would be a little bit higher than that because we've gone over the XOP, but it is on a roll here now. We had a big decline. You can see this yellow line. We had a big decline, and now it's starting to come back again. Semiconductors all the way down here. Technology, the blue line, up here. So they're sort of underperforming over this year to date. But let us look at over 5 years, which are outperforming. Yellow line is the XOP. Now, the XOP is not strictly oil. It's oil and gas, and has to do with the drillers and the whole aspect of oil drilling and receiving and recovery. So XOP is an all-around, not just oil, but an all-around company or group of companies, and you can see it's doing well. What's this blue line? Yeah, the XLK is the tech field. Then down here, XSD, this brown line, you could just see it in here, slightly outperforming the S&P 500. The brown line is the semiconductors, and XLY are the consumer discretionary. And XLV, this line down here, yeah, healthcare. Healthcare is having a hard time over the past couple of years, isn't it? Look at this down here, where the black line again is the S&P 500. And healthcare had been doing okay, and then just kind of flattened out. There's a few stocks in there, and we've shied away from them for this entire year. But here's what I want to bring out. Let us look at the QQQs, which is the NASDAQ 100 stocks. QQQs is this yellowish brownish line up here, and again the S&P is the black line. So the S&P over the past 5 years up to the beginning of this year is up about, what do you want to say, about 95% in here, where the QQQs are up about 115%. So the QQQs are outperforming the S&P 500, and why? Because it has the tech stocks, it has the semiconductor stocks, it has the stocks that are the best out of the NASDAQ. You know, Microsoft is in there, Apple is in there, so some of the big names are definitely in there. But what I want to show you is, okay, the QQQs are outperforming the S&P 500, certainly not doubling it, but the QQQs are up 20% more than the S&P 500. So there's only a 20% difference between the S&P 500 and the QQQs. But had you picked, now this is 5 years, not counting this year at all, so there's about almost a 4-month lag between these returns here. The QQQs returning 141% over 5 years, up right until the beginning of this year, where the sector stars that we pick out of the QQQs, these sector stars are up 3 times more than the QQQs. So if we went back to this slide, we are looking at the QQQs here. Well, the top stocks that we pick, and we pick them each year and change any if necessary and rebalance the portfolio. would be all the way up here. So just by following a systematic performance of these stocks using the clean surplus return on equity, in other words, the best out of the QQQs, you would be way up here, 3 times more than the QQQs. And if you compare it to the S&P 500, we're looking at about a 5 times return. Let's go back again. About 5 times more than the S&P 500 just by selecting the stocks with the highest clean surplus ROE and those other statistics we talked about, revenue growth, net income growth, and debt. And if we pick those stocks with the higher clean surplus ROEs along with those statistics, we are way up here, because these are the portfolios we use. Now, our growth portfolio of 30 stocks, which is such a nice portfolio, is doubling the S&P over the past 5 years. So the growth portfolio is not as volatile as the sector stars of our ETFs, not as volatile, but it doesn't return as much. So this is the portfolio that we recommend. This is the portfolio that we have a 22-year track record on, and over 22 years, we are 2.5 times the S&P. Over the past 5 years, we're doubling the S&P 500, and that's up to the beginning of this year, or call it the end of 2024, for those 5 previous years. So we're doubling the S&P 500 in over 22 years, 2.5 times that of the S&P 500. But the big difference is in here, the sector stars in your tech, your semiconductors, and the QQQs are outperforming the S&P 500 index, and the sector stars coming out of the QQQs and 1 or 2 other top indices that we showed in the charts, returning 3 times more than the QQQs, and the QQQs are returning more than the S&P 500. We like the growth portfolio. That's our favorite portfolio as far as being consistent and outperforming most every year the S&P 500, and over the 22-year period, doubling or 2.5 times the S&P 500. So it's got a serious track record here, folks. And the sector stars, just over the past 5 years, as we started doing research 10 years ago on these sector stars and the QQQ portfolio that we construct every year. And then 5 years ago, we went into actual returns following them. I should say 5 years ago, we went back 5 years, so that's back testing. Okay, that's nice. It just gives you an indication of what might possibly be. But then these are portfolios that we change once a year, and in the past 5 years, you can see how well they have done. So, folks, we had a pretty good week this week. The portfolios that we've picked are doing very well indeed, and over time, they do exceedingly well. So you can go to the beach this weekend, you could go for a walk, play golf, play tennis, whatever the weather is like out there. In other words, take your mind off the market, because it will be back here open Monday. And folks, you stay safe over the weekend. We'll see you back here in a couple of days.